The magnitude of the concentration risk that you're getting out of tech may end up coming short of expectations. Everything everyone sold to get into the tech trade is now outperforming for the last 4 to 5 weeks. There's tech stocks that are down 50%. I don't think we're going to see $40 oil.
Pleased to welcome to our show a new guest, David Nicoski, CIO of Vermilion Research. On the agenda today on Monday, August 3rd, oil just shot down by 6.5% after Trump apparently called off a strike on Iran. Breaking news over the weekend, the U.S. intervened in Japan and bought Japanese yen for the first time since 1998 on this scale. We're going to talk about that and the implications for U.S. markets, as well as the rising bond yields. We're going to recap the Fed and go over David's predictions for what the markets are going to do into the rest of the earnings season and perhaps into the fall as well, and which sectors he likes the most. David, welcome to the show. Good to see you.
Hey, thanks for having me. Over the last, since the end of June, you've seen quite a bit of rotation into, sectors that have been underperforming dramatically. So you are seeing relative strength improve, within financials, healthcare, and to a lesser degree into staples. I think it's a real rotation. I think the magnitude of the concentration risk that you're getting out of tech may end up coming short of expectations. And I think it's very important to realize that everything everyone sold to get into the tech trade is now outperforming for the last 4 to 5 weeks.
Okay.
So
since you brought that up first, let's lead with that. So volatility in the semiconductor chip space. I'll use Korea as an example. No doubt you've seen the news that the Korean Kospi index, which is up until a few months ago the world's #1 performing index year to date by performance. That all changed last month when the index was down 33% in July alone, which was the biggest drop in the country's history, worse than the 1998 Asian financial crisis, worse than 2008, and worse than the tech bubble burst. And I think something like 1.2 million accounts got margin called, which is roughly 3% of the population. Just over the weekend, or actually over last week, the index rebounded about 18%, but just today it's down another 5%. Anyway, is this a leading indicator, do you think, for what could happen to the U.S. semiconductor space? Intel already saw the same fate, but not all stocks are this volatile in the U.S.
Yeah, we have a pretty diversified economy. I came out with a bull call December of 24, January 25 on emerging markets across the board, including Korea. And I discussed, at that point, and I'm a technical analyst, but it was, most stocks were trading at 4 and 5 PE. When you get through the cycle, and if you looked at the breadth within Korea, just 2 or 3 months ago, their breadth just absolutely dropped off, moving from 70% of names above the 200-day to, 15%. It was being held up by 2 stocks, and you saw that everyone was selling every name they could, from, the banks to the steel companies like POSCO, and they went straight down. So this is concentration risk. And, I think that the U.S. market mirrors a lot of that. And, looking back at other periods in time, whether it's .com, when you get a sector up to 40% of the weighting of the market, right now we're about 42%, technology. It doesn't mean it can't lead for a period of time. It just means that the concentration risk is starting to get egregious, right? Human behavior is controlled by fear and greed. And right now there's a lot of greed on Wall Street, thinking they know where this is going. And like I said, everything they've sold off in the last, year and a half is making relative strength bottoms. So you don't have to call it top. You do have to recognize that breadth is improving in all of the areas that were sold off to move into tech. And that's what I think that's more important here.
Before we go back into the U.S. tech, EM strategy monitoring MSCI EM for a potential downgrade. This was dated a couple of days ago on the 27th of July. Tell us about your views here.
Yeah, I think with the strong dollar, you have a lot of issues with emerging markets. If you look at some of them, and I wouldn't put them to aggregate them all the same. For instance, China, the FXI is actually up 15% against the S&P 500 in the last 30 days. So you are creating bottoms in names. If you look at China, I mean, their 10-year yield is, I think, 1.7% right now. That is the lowest in the entire world from a industrialized economy. So there are issues with the dollar right now, and Japan. And if I do see continual weakening against many of these emerging markets, I expect them to once again outperform.
Okay, so you don't think that Korea is an indication of what's to come for the U.S.?
I do. I do.
You do. I'm specifically the semiconductor and tech space.
Yeah, if you look at the tech-heavy, countries out there, be it Korea, be it Taiwan, be it the Japanese, the Nikkei 225, they all have similar distinguishable characteristics. They all broke a very parabolic up move, and are breaking the shorter term uptrend. If you start breaking the longer term uptrends, especially in the US, I would see that that's a vulnerable signal that we are going to follow in the footsteps of what we're seeing in Japan and Korea, and to a lesser degree, Taiwan.
Before we continue with the video, let's talk about a company that's building serious gold leverage for the long term. Our sponsor today, Stellar Gold, is sitting on 3 major Canadian projects. Tower and Colomag are among the largest undeveloped gold sites in the country. The Tower project alone could be worth $2.5 billion after tax at a $3,200 gold price assumption. And if prices go higher, so does its value. Colomag spans over 1,000 square kilometers of greenstone deposits and could be Canada's next big gold camp. They also have Hollinger Tailings, a cleanup project that could deliver near-term cash flow. Across all projects, they've drilled over 16 million ounces of gold, which would cost over $2 billion to replicate today. With a seasoned team, Stellar Gold is one company to watch. Scan the QR code here on screen or visit stellargold.com/David Lin to learn more. I want to pull up a chart that you have in your slide deck and just go over the technicals of the U.S. markets right now. And the software index in particular, actually, before we pull up your slide deck, let me just show you a chart of the SMH, which is the Van Eck Semiconductor ETF, as a proxy for the semi industry here in the U.S. Already down about 23% from its top early in June. And this decline is, some say, mirroring the decline of the beginning of the 2000 dot-com bubble bust. But if you zoom out and look at this index over time, you'll see that it's moved down before, probably just not in this kind of magnitude at this rapid of speed of decline. Over 2022, for example, when all markets went down, it was down 50%. But that was over a span of 9 months. Here, we're talking about a month and a half. It's already down 25%. What do you think is happening right now?
Well, I think you're going to look for support at the 200-day moving average. Many names bounced off the 200-day moving average here more recently. That's where it should find support. When you look in the context of historical moves and the percent above the 200-day moving average, this came in very close to what the dot-com bubble was. Back then, semis were about 9% of the market. Today, it's at the peak, it was 22%. And that's not including the companies that actually are not in the semi index that actually develop their own semis, right? You have Amazon, you have Google developing TPUs. So in reality, that number is a lot bigger than the 22% I stated. So they're effectively competing with companies in the semi index, but are not part of it, right? So I wouldn't phrase this as I'm calling a top. I would say that we are parabolically extended. We had close to 90% move above the 200-day. The only other period in history that topped that was the dot-com bubble, and it was 9%. Today we hit 22%. If you're playing probabilities and you have that information, I would say that it's time to, step outside the bounds and not have 22 or 26% in semis, especially when there's other sectors that are showing bottoming characteristics in terms of relative strength.
What else is at risk of a further decline right now?
Well, I think the AI space, is you are seeing corrections where you're getting names like Bloom Energy, some of the engineering and construction companies. You're starting to bifurcate in terms of individual names. If you looked at a name like Sterling Construction versus Mastech MTZ, I don't have those in the slides, but you're getting divergences in many stocks. And in other words, the correlation of the market is actually very low. If you look at names like Costco and Walmart that had premium valuations, much like Apple, you can be a good company at the wrong price. And what you are seeing is that investors are stepping away from the assets that they hid in, during a period in which the average consumer discretionary stock was trading down. They bought Costco, Walmart, tech. Apple becomes a very safe play in an environment where no one knows where the AI spend is going, and then you see Apple, have a parabolic move up, and then you get rotation, and you get it back into Microsoft and Amazon, and that's the type of environment we're in. Single stock skew is very high. Correlations of the overall market are very low. So you're seeing big moves in individual stocks versus the index.
Okay.
And I think this is a stock picker's market from that perspective.
Okay, I'd like to jump ahead now. If we're going to finish off on the markets, we're going to get David's outlook on what's going to happen into earnings season, or at the end of earnings season, rather, and we're going to get David's top picks for his sectors that he prefers. So stay tuned to the end of the interview for that. I want to jump ahead now to talk about Japan and what happened over the weekend. So it was kind of leaked, by the way, last week that Scott Bessent might do something with Japan. There was apparently a to-do list to buy $5 billion to $10 billion of Japanese yen at a conference at Camp David. The notepad was, this is funny, kind of a interesting story here. He left a notepad on the table that says to do, followed by buy Japanese yen, 5 to 10 billion. Interesting. Now, what actually happened over the weekend was the Americans intervened to boost the yen for the first time since 1998, which was the Asian financial crisis. Intervention comes after the yen touched a 40-year low. So we know that the fiscal situation in Japan has gotten worse. Their debt and deficits have projected to widen. And the yen, that was already weak, has been sliding to even weaker lows. The Bank of Japan already tried to intervene, raise rates once, and now the Americans are intervening. Just before we get into the details here, why do you think that the U.S. did this?
Well, I think that, Japan interest rates are relatively low to the rest of the world, and they're really offsides. And I think the U.S. needed to strengthen the yen so that we don't have as they head back in '98, the Asian contagion. It becomes apparent that there's a large yen carry trade taking place. The problem with doing this intervention is their yields are actually going up today, and their currency is actually strengthening, which actually, should push people off sides if they weren't there. We're certainly not seeing it in our equity market, because historically what you do is you borrow in yen at lower yields and buy U.S. assets. And so we're not seeing that take place in the U.S. equity market, to the extent that one would have thought, with all of this information, changing so violently here in terms of the yen and the yields moving up significantly higher. So I don't know if most firms got on the right side knowing this would take place, or that we have something coming down the pike that we don't know about yet.
Do you think that if the U.S. didn't intervene to prop up the yen, and if the yen, is the logic here, David, that if the yen declines further, then the Bank of Japan would likely intervene some more, raise interest rates even more? And if that scenario were to happen, the yen carry trade will reverse and we would have a massive sell-off of U.S. assets, which they don't want before the midterms. Is that the logic here?
I think that's exactly the logic. But we don't have yield curve control. The Japanese government interceded in the currency market a number of times and failed. I think they needed a joint effort with the U.S. to actually turn the tide there and actually get that to move in the direction that they really need it. But if you do have this yen carry trade, the strengthening of the yen and yields moving higher should collapse that yen carry trade, or at least make the risks much higher with what's happening here. So it's almost like the U.S. government is trying to force the unwind of the yen carry trade with what they're doing, because everything that's happening is not advantageous for the yen carry trade right now.
Speaking of the yen carry trade, and I like to bring this up, you're a technical expert, and this might be of interest to you. So I'm going to pull up the Japanese yen, and we're going to go over that versus the S&P 500 here. I'm not insinuating that correlation equals causation. I've just noticed something. This is the Japanese yen versus... So the yen versus DXY, dollar rather, the yen versus dollar pair is the bar chart, and the blue line is the S&P 500. Yeah. Now, obviously, they don't move together perfectly. I've just noticed that the correlation has become a little bit stronger over the last, I would say, 2.5 years or so, especially since you saw both declining and moving up together in 2025 and more or less moving the same direction. Have you looked at this correlation and this relationship at all?
Yes, I have. Yeah. There's definitively a correlation there. They don't move in 100% rhythm, but there certainly is. We all understand. Most on Wall Street understand what the yen carry trade is. And that's why I say I'm actually surprised at the behavior of the market today relative to what we're seeing in the Japanese yen and in Japanese bonds.
Right now, though, are you bullish in the dollar?
The dollar's breaking an uptrend. We just fell through some support levels right at the 100-101 level. So I would want to see us retake that. I think there's a circumstance that, as Bob Farrell, once, a very famous technician once said, everyone gets into the foreign markets at the top. And perfect example, Korea. I was calling a bottom in January of 25. It's all over my, timeline. It's in my calls. At the last, in the last 6-8 months is when you saw everyone run into the Korean Kospi. My concern here would be that you go through long-term cycles. In April 12th of 2002, 2 years after the dot-com bubble, the U.S. dollar broke a parabolic uptrend. That sent the S&P down 25%. So the unwind of a currency, and it really depends on how fast you fall. It's not that you broke the uptrend, it's the rate of change in which you broke that uptrend was very, very fast, right? So if you look back at the 2002 time period, April 12, 2002, we made a call of repatriation. Again, that call hasn't been made in 24 years. So it's not something that happens very often, but when it does happen, it can be consequential for the markets.
So I think somebody watching this right now might ask, why are my taxpayer dollars going to bail out or intervene in a foreign currency market? In other words, Japan. Why did our taxpayer dollars just go to Japan in the order of several billions of dollars, propping up the Japanese yen? What does this mean for us here in the U.S.? And I think another way to answer this question is, if Scott Bessent hadn't done this, what would be the consequence to the U.S. markets?
Well, the consequence would be that we're going to allow, much like the Asian contagion, which you had Thailand. The consequences of this would be that money could come out of the market dramatically if their currency continues to weaken. Again, what they're doing here is has some good and bad to it, right? They're kind of speeding up the process of the yen strengthening, which is good because it can buy commodities. Japan doesn't have any commodities. I think they provide 3% of their own oil. They have to import all of it, so they come to a standstill if their currency continues to weaken. And I think that's what the Fed is trying to trying to force the yen to gain some strength here. The question's still out and the jury's still out on whether or not this pushes the yen carry trade to an end. Because the two things that are happening right now, yen strengthening and yields moving up, are actually anti-yen carry trade. So, there's a lot of hyperbola, and you don't make decisions in 24 hours. You wait until the smoke clears before you see what actions are taken. And as a technician, I care about actions. When for instance, when they come out with a GDP report, I can't buy the GDP. I have to buy what I see technically is outperforming in relative strength, right?
Yes.
So I care about action.
Right now, we have oil falling like a rock, and oil's been moving up like a rocket and falling like a rock within intraday intervals. So it's not like it's a surprising move. But how would you, as an investor and trader, interpret the moves of oil, especially when you consider that the Fed bases its expectations on inflation on oil, partly, right? Even though they look at core PCE, but of course, the oil markets do dictate where inflation expectations go overall. At least that's what's been happening so far.
I think, the volatility you're seeing in oil, it's certainly more geopolitical in nature. And I think it's important to remember that the SPR is doing what it's supposed to. They're releasing oil out of it. At what point do you hit a level that you have to stop or, stop exports of refined product? The crack spreads are near all-time highs, all-time highs. It's pricing in $140 oil on crack spreads. So if you look at the oil market and try to make any sense out of the gyrations and the tweets that we get out of from our leader, I don't think you're going to find anything to give you an edge there. What I will say is, if I asked everyone on this show, what is outperforming from the COVID lows, is it XLE or XLK? Most people wouldn't be aware that XLE is actually outperforming tech. Okay. So, we all have this, one thing relative strength does to you is it tells you where everyone's positioned. When energy is 3% of the market, just to be market weight is a 3% position. Most people don't even have that. If energy moved up, 20% from here, or received 1% of fund flows, that's a 33% gain. That's pretty substantial. And I think, just ignoring energy because you can't figure out the price, many companies in here are very cash flow, free cash flow positive. The long-term trends suggest that, you're above a huge base, a 20-year base on XLE. Give it time. These are processes. You don't wake up one day and say, I need to go long energy or I need to short it. Right. I see a lot of people get ecstatic, on X and the universe saying, oh, I can't wait to short energy. There's tech stocks that are down 50%. I don't think we're going to see $40 oil. That's what I would tell you.
We're not going to see $40 oil. That means we're going to get effectively higher inflation expectations here to stay, which means bond yields are going to keep going up. Is that the play here, to be short bonds?
I think bond yields are going to move higher. And if the only way I think you get bond yields moving lower is in a lower equity market to force people into bonds.
Okay.
And we're not getting that at this point. So,
Yeah, by the way, on the screen right now, I have what you talked about earlier, XLE in the bar chart, XLK in the blue line, beating inflation. So XLE has been beating XLK, like you said, since 2021, 2022, the 2020 COVID lows. Now, I talked to the director of the University of Michigan Consumer Sentiment Survey, and it was an interesting conversation because she brought up the fact that the concern for inflation has been a relatively recent phenomenon. All throughout the 2010s, inflation has been relatively stable. Disinflation was the trend, and so consumers weren't worried about rising prices at the same pace that they're worried about now. And so as an investor, when you're looking at this trend and consumers are all of a sudden, not all of a sudden, but over the last couple of years becoming more aware or concerned about rising prices and the unaffordability of life, more so than maybe 10 years ago, how does that change your overall thesis on which sectors to overweight and underweight?
Yeah, one of the charts that I sent in that presentation, if you pull up XLY, sure, it's at a 14-year relative strength low versus the S&P 500. 14 years. Pull up a chart of Home Depot, Lowe's, Lululemon, right? Like they're disasters. If I keep hearing about this K-shaped economy, every stock that the upper end of the economy would buy, Lululemon, right? Expensive pants, right? There is not a K. There is weakness in the consumer sector, and you have to look for the individual names. McDonald's is at, I think a 14 or 16-year relative strength low. That means that if you bought it 14, 16 years ago, you're break even on a relative strength basis. So you really have to look. You have far underperformed the market. And if you look at individual stocks, you'll see names like BJ's Restaurants or Cheesecake Factory are actually outperforming McDonald's substantially. Walmart and Costco, everyone, was buying them, pushing them to a top at valuations that, were unfounded. Target is actually outperforming Walmart and Costco over the last 6 months. Handily. I mean, absolutely handily. So, this is a stock picker's market. You're seeing less group correlation. So if I look at a group with 10 names and I have all of my proprietary research that, breaks up the market into 13 sectors, 440 groups, I can look at a group. And what I'm seeing is the bifurcation in individual groups where you have a name like Target and Walmart together. And you're seeing that one's going up and one's going down. The correlations are off, and that's why I brought up correlations earlier in the interview.
Well, I saw a comment on one of my YouTube videos that said, this is the commenter's post. He said, I see people going to baseball games, stadiums are still full, restaurants and bars are still full on the weekends, people are going to theaters. By the way, Spider-Man just opened last weekend. It was the single biggest box office open in American box office history. I think it was $168 million in box office opening weekend. And the comment is, people are still going out and spending money. As a market technician, what data would you need to look at to either prove or disprove that statement?
Well, when you look at, I'm bullish movie theaters, by the way.
Yeah.
There's a slide in there that shows the top performing groups in the market. I think it's closer up. Scroll up, it's a gut coloring on it, and it points out the top, that one right there. So if you look at that, you're going to see movie theaters. It's like the 8th one down. So this is a relative strength ranking that we use. The strong groups are on the left hand side of the page. The weaker groups are on the right-hand side of the page. And that's just a snapshot of the first page. That list goes on and on. So I'm going to say we are, the consumer spending money, but you can have a stock break out to new highs and underperform, right? Relative strength is key to finding the strength in the market. And, when it comes to looking at where the strength is in the market, and you see the groups up here in terms of consumer discretionary, right? I have probably 70 groups in consumer discretionary. You see just a few names up there, so picking the right group in the sector is key to outperforming the sector. And I think a lot of people don't understand what relative strength is. The banks are far outperforming the consumer discretionary sector. You see a number of financials on there. You see a number of healthcare. When you look at the right side of the page, major automobile manufacturers, at the bottom, what you're seeing is that the consumer that has to marry a 5-year payment, be it Thor Industries, be it Winnebago, be it Camping World for an RV or boats, those are all going to be on the right-hand side of the screen. So what you're seeing is people are buying opportunities or something, like at a movie theater, you're buying an experience.
Somebody told me the economy isn't doing well, and therefore people have less money to spend on big purchases like boats and big vacations and whatnot. And so with the money that they do have, they're going to spend money on more affordable experiences like movie theaters, potentially bookstores, like you mentioned here, restaurants, maybe casual dining. Does that make sense? Or do we see?
Yeah, absolutely. They're buying experiences. That's what they want.
Okay. I think this is a good segue to talk about the sectors that you would overweight and underweight right now. You mentioned a few to me offline. So we have a situation where inflation expectations are high. Potentially the Fed may raise interest rates. You expect bond yields to go up. I don't know if you think the yield curve is going to steepen. It certainly did last week with the FOMC meeting concluded. We haven't talked about that yet, but what is your expectation for what is going to go higher and what is going to go lower?
Well, right now we're still overweight tech, and it doesn't mean I have to wait for longer term trend lines to violate. So what I'm seeing, outside of the tech call is that the breadth of the market is improving in a number of other sectors. Those sectors are financials, banks. We made a call about a month ago on insurance related names. The problem with the insurance related names, and as a technician, I can see the trends change and see relative strength spike. If the AI trade is crowded, you're going to want to look at insurance names that don't have the, as much exposure or limit exposure into, funding AI debt. You are seeing credit default swaps blow out and on a lot of and when I say blow out, I mean they've moved up significantly. I don't want to say they blow out that no one wants them. I'm saying, if the risk is there, you're going to see credit default swaps on AI related names move up substantially from here to blow out. But, those are the things in the back of my mind looking at, how crowd behavior is at times like this. So I do like the insurance names. I would aggregate it to, say, I want the names that are less associated or don't do as much private debt or private equity. I think are going to be safer. I think the banks, especially the ones outside the country, European banks went from negative interest rates to positive. They've been outperforming for almost 4.5, 5 years. That's been a strong buy for us. UBS, Deutsche Bank. That group has far outperformed the U.S. markets handily. Okay. So, when you get down into healthcare, I'm seeing IHI. It's a group that I highlighted in the slides. You're seeing, Medtronic, Abbott, Baxter, start to outperform here in the last month and a half. And I think that's going to continue as funds start to move down their tech weighting, and they can still be at a market weight, in tech, but it's a substantial portion of their assets.
Okay. Well, I see, by the way, at the right side of the list, you have precious metals mining and to some extent rare earth metals as well in red, worst performing groups. That's based on current sentiment or your future sentiment, by the way?
That is based off of solely relative strength.
Relative strength. Okay.
Just relative strength. It's literally an algorithm tracking relative strength.
Do you ever use this as a contrarian indicator? If something is really, really red or really, really green, you'll either sell it or buy it?
Yeah. I just look at the trends, and right now gold is at an interesting area. In March, I indicated that gold, the 200-day was at 4,100. I think we had 4,103 that day. It reversed, had a substantial move up, and not to new highs, but came back, and we're sitting at that horizontal support level right around the 4,100 level. So I'm watching that, with enthusiasm, because I think if the dollar were to weaken here, we're gonna see some move in the precious metal. So right now we're hanging out right around that level. I'm interested in it, at that 4,100 level. I think if you went down to the 4,000 level, it would be less. I'd be less enthusiastic, but we may be building a bottom there from what I see, and that's based on relative strength too.
Great. Appreciate your thoughts and insights, David. Tell us where we can find your work and follow you.
Well, there's a few different ways to do it. I'm on X at Dave Vermilion, 1L in Vermilion. There's also a Substack called Vermilion Research that you're welcome to check out. I touch upon, sector rotations and that type of thing on there. And then there's vermilioncap.com is our homepage on the net. So feel free to look us up, and any questions, feel free to contact me.
Okay, excellent. We'll put the links down below, so make sure to follow David Nicoski there. Welcome to the show, David, and we'll speak again soon. Take care for now.
Thank you, David. I appreciate your time.
And thank you for watching. Please do like and subscribe and follow David. Links down below.